Hey everybody, got another reaction video for you. I told you that if you stuck around, I'd find all the good ones for you and then show them to you, and then you could just enjoy. But I'm sorry for the clickbaity title. Dave Ramsey doesn't totally agree with me, but he somewhat agrees with me, and so I think it's worth checking out the video and see where our thoughts align on all the financial stuff. Hey everybody, my name's AJ, and this is The Wealthy Idiot Show. Before we get into it, smash that like button for the YouTube algorithm. It helps us out tremendously, and we could spread more good financial information to more people, which is incredibly important. Today I found a video by Dave Ramsey where he's talking to a gentleman who has investment properties, has leveraged those investment properties, and he just found Dave Ramsey and he's trying to figure out what to do. Kinda sounds a little familiar. In fact, a lot of his information, besides his age, is actually pretty close to what we got going on here at The Wealthy Idiot. So we're gonna check it out, see what Dave says, because he doesn't totally disagree with what we say here. And this video is called, Is My $1,500,000 in real estate debt worth it? It's a very good question. I guess it would depend on a lot of factors. So let's find out.
Gary is with us in Chicago. Hey, Gary, welcome to the Ramsey Show.
Hey, Dave, how are you?
Better than I deserve. What's up?
Thanks for taking my call. It's really a pleasure. My question is this. My wife and I, we're 50 years old. About 10 years ago, we figured out what we wanted our retirement to look like. And I should mention we found you about 1 year ago. So pre-Dave Ramsey, we developed a plan. And we wanted our retirement to look like a vacation property in Kiowa Island, a vacation property in Park City, Utah, and somewhere else a third primary home. And so what we did was we went out and bought a rental property in both of those two locations. Took out a mortgage on both of those two, while we still had a mortgage on our primary residence as well. For 5 years, since we bought those properties, we got them about 5 years ago, we've been short-term renting them. They cash flow positive. They've been great. We have better than 50% equity in all three of our properties, our primary residence and the two rentals. But we realized that's not the Dave Ramsey way. But we've got a good income, a good net worth, the cash flow positive. We're about 10 years away from retirement. And this is like our dream. So I kind of want to know what you would do. It sounds like based on your personal experience, we've got some risk.
Okay. Well, it may not be the Dave Ramsey way, but dude, you're killing it. Like, you're knocking it out of the park. You have multiple properties. You're leveraged less than 50% in all of them. So if he's got 1.5 million in debt, it means that his total value in all of his properties is 3 million. He's got 1.5 million dollars just in real estate. If he was to turn around and sell it today, he'd have 1.5 million dollars that he could use for something. And he said something very important. He's cash flow positive. If you've been cash flow positive in Airbnb for this amount of time and you did it through COVID and everything, dude, you're killing it. May not be the Dave Ramsey way, but dude, you're totally killing it. I got some more thoughts, but let's watch a little bit more.
Well, I think everyone would agree that debt equals risk and more debt equals more risk.
Okay. I remember now what I was going to say about that. So yes, debt equals risk, more debt equals more risk. And I've talked about that here before, that the spectrum of risk isn't like you're out of debt and you're in debt, and then now there's like this little sliver over here where it's like you're in a little bit of debt, you're in a lot of debt. The spectrum looks more like if this is security and safety and this is wild and crazy and just gambly, you're just gambling all over the place. And you get into a little bit of leverage debt, like with real estate, and you're less than 50% leveraged, you're like still way over here. In fact, I think keeping money in cash just sitting around is probably more risky than getting leveraged and getting into real estate. I mean, it's not even risky. It's a guaranteed loss. You're just going to lose money, right? So I think that by producing positive cash flow and getting to the point where you're financially independent instead of dependent on a job is the most secure thing that you can do. And you should be probably way more financially independent than you need to be in order to maintain your spending. And I think this caller, he's on the right mark here. Gary from Chicago. He's on the right track. He's doing good.
Agreed?
Very much, yeah.
Okay.
We have no other consumer debt. So
that means you have less risk than other people who have a lot of debt. but you have some risk. So I can't tell what it is. So how much mortgage debt do you have?
So to keep the numbers real simple, we owe $500,000 on each of the three properties. Our primary residence.
So you have $1.5 million in mortgage debt.
Correct, but better than 50% equity
I heard all
in
that.
each of those properties. Yeah, okay.
And your net worth is what?
3.3 net worth.
All right, Dave's trying to do the math here. So 1.5 million in real estate, and he's at 3.3, which means that there is an extra 1.5 plus 300K in something else, so 1.8.
So what's the other 1.5 in? Or 1.8?
So it's
There you go. He got it. We got it, Dave. We're on the same page.
401ks and brokerage accounts.
Okay.
Wait, I thought you couldn't get rich on 401ks. Oh, no, wait, shoot. That was a different video I debunked. Oh, that's all right.
And how old are you guys?
We're 50, and our household income is $400,000.
Okay. I'm not panicking
Nice.
about this. The only thing I would adjust is, here's the thing, okay? It's not a Dave Ramsey thing. It's just when you scour the people who have a net worth of 1 to 15 million, we find in the data, and we did one of the largest studies of millionaires ever done a few years ago, we find in the data some commonalities, meaning that they're causal, okay? These things caused people to have this net worth. One is they did what you did. They built a really nice retirement plan, nice 401k. They usually got $1 million, $1.5 million, like you've got, in your 401ks, your brokerage accounts, your retirement accounts, okay? Two is they have paid for real estate, their home. So as an example, a scaled down version of where you are, what we found in the millionaire study a lot was a guy or gal, a couple, with a $600,000 paid for house and $1 million in their 401k. So they got $1 million net worth, or 1.5, 1.6 net worth, and they have zero debt.
The issue I have with this millionaire study is a couple of things. One is if you count your home, the equity in your home, it doesn't count in your retirement estimates, except for if you have it paid off, you no longer have a payment. It doesn't produce you any money. It is going to cost you money. It'll cost you less money in retirement than it will if you're paying for a mortgage, but it's still going to cost you money. You have to repair it. You have to keep it up. You're going to pay taxes. No matter what, you're going to pay money into your home. It does not matter. But real estate that's invested is going to pay you money. That changes the factor. You could also sell it and get money back. So I don't like using your home in your net worth when you're considering how much you need for retirement. And so I think that changes the scenario a little bit. So if you have someone who has $1 million home, they have $1 million net worth, and they're living in their home and they're not moving, and they decide to retire, they can't. But in Dave Ramsey's study, they'd still be a millionaire. So I'm curious about the number of people that have that effect. The second thing that I think is missing here is that most people that are going to be millionaires are going to be older. That's just statistically true. If you're investing money over a long period of time, you're going to be older by the time you're a millionaire. There's no way around that. So yeah, you got all the Hollywood celebrities and sports players, but at the end of the day, the people who are investing money are going to be millionaires when they're older. Now, when you're older, what happens in like my case? So I'm renting now. Let's say when I hit 65, I just turn around and buy a house for cash. It's going to look like I paid off my home and that's what made me a millionaire, but I was already a millionaire and I bought the house for cash. How many people are doing that? Or at least just paying their home off much quicker once they're already wealthy. So I think that this is a little bit tricky when you're looking at data and you're just like, look, all the millionaires have X, therefore you should do X. And then what you got to do is kind of look at what people are doing in order to compound their money. And I think that a lot of people are in 401ks, like he's pointing out here. You instantly double your money in a 401k and then it compounds, which is outstanding. Index funds, mutual funds, get yourself something diversified where you put very little effort into it. Roth IRAs are fantastic because you pay no taxes when you start pulling money out on the tail side. And leveraged real estate has a great track record of this. So I'd be kind of curious to know how many people are leveraging real estate to become wealthy. And then, when I get to 65, I will probably buy a house for cash. And that would fit into Dave's plan and his statistics, but not in the way that he thinks that I should. So I don't know. I have a little bit issue with him using the way that he uses this study to try and say everybody's got to do it this way.
And we find them at 52 years old a lot like that. Like we found thousands of those that were millionaires. It sounded just exactly like that. So what we've figured out is that paid for real estate going into retirement, having zero debt real estate or anything going into retirement, is a stabilizing factor. And it makes your retirement a lot less stressful. So you said you're 50?
We're 50.
Yeah. And so if I woke up in your shoes, would I panic and go, oh, Dave Ramsey says I got to get out of debt? No, this is all real estate debt, okay? But you...
Wait, what does he mean by that? Does he mean that it's less risky and you don't need to panic because it's not consumer debt? All right, Dave. Kind of sliding over to my side. All right, so something important here. When you're younger, that's the time to take more risk because you have plenty of time to hit the dips and the highs. So for example, in the market right now, we hit a severe dip. Well, if you're in retirement and you hit this dip, that's painful. If you're young and you hit this dip, it's great because you can keep buying while everything is low. And then when it starts to come back and go back up, you're going to make it rich. So same thing applies for real estate. Leverage while you're young and you have the capability of handling it. You have a $400,000 income. And then when you start getting close to retirement, maybe that's when you start paying stuff off. So I have a different plan than Dave here. And it still, I think, works in sort of Dave's plan a little bit. But I think it's interesting. He's a little bit softer than he normally is on this one.
Make $400,000 a year. So how fast do we pay off with all these rents coming in too? How fast do we pay off this $1.5 million? Well, I'm definitely going to do it in a decade.
Yeah, since I met you and online, what we've been doing, we've created a little debt-free chart, and what we've decided to do is we've taken the rental property with the highest interest rate on it, and we're going very intentional with that one. So all extra income, whether it's household or whether it's rental, is going to court against that one, and then we're going to pay off the other rental. And then what we plan on doing as we retire is whatever equity is in our primary home, we're going to downsize into something that size, so we have no primary mortgage on our primary home.
Well, or here's the other.
See, he's got it, like Gary's already got it. He's the numbers guy. Like, he sat down and figured this stuff out. He probably knew that those properties were going to cash flow before he even got into them. And then he's saying, like, I'm going to get out of this home that we're in now. We're going to get into a smaller home that has no mortgage at retirement. He's got it figured out. Gary's got it, man. I think what happened here is Gary had it all figured out, got a little nervous, started watching Dave Ramsey. Dave Ramsey was like, all debt's bad debt. And Gary was like, uh-oh. Like, maybe I kind of jumped the gun. Maybe I didn't do enough, math before doing this thing. And he kind of panicked a little bit. I think Dave kind of, fed into the panic. And now Gary's calling, wondering what he should do.
Other thing, your $1.8 million will be 3.2 in 7 years if it's in good mutual funds.
Yep, which it is.
Yeah, and so you reach in there and touch it when you hit 60 and just pay it off and keep it if you like the primary. You don't necessarily have to downsize the primary. How quickly can you pay off $1 million of the $1.5 million?
Well, I've got the one house planned at 4 years. That's $500,000 on that one. So I would think we could do it in 8 years. Probably quicker because once we get one paid off.
Exactly.
Yeah.
I'd like to see you do the whole thing in about 8.
I think we can.
Yeah. So if you get to 59.5, you got anything left, just take a little out of your retirement account and pay it off. If you like all 3 properties still and you still like your plan, the only thing I did was disturb you about the debt, setting you up on a decade or less to be clear of the debt. If I'm in your shoes, I think that's fine. And let me tell you what will end up happening. You're going to get obsessed with this. You're going to end up doing it quicker.
Dave, I've already got a side hustle with my income. Trust me, I'm going.
He's driving Uber, making $400K.
Ask, what is your side hustle? Do you mind us asking?
Yeah, it's logistics. So there's companies around Chicago that will help you deliver things. It's like doing DoorDash, but just not DoorDash. It's those kind of things.
That's hilarious. $400,000, and he's got himself a side hustle.
My wife thinks I'm nuts.
You
she
are.
absolutely thinks I'm nuts.
Well, you kind of are. Yeah, you kind of are.
What do you do? What do you do for a living?
We're both in sales management. So I hear you talk about the virtues of sales careers. We've been living sales our whole life and wouldn't change it for a thing. It'd be great. Yeah.
Well, that's the other thing. Here's what happens, okay? As now you have a new goal that's got you fired up, your sales are going to go up.
Yeah, but the level.
So I just posted about that on Facebook or Instagram or Twitter or all of them. I'm not sure, but there's like a weird brain chemistry thing that occurs when you start and you get on the right track, whether that be paying off debt or investing, where you start to prioritize your income better and looking for higher income. And it's something like people who are paying off debt intensely or investing intensely seem to be able to find higher incomes at a better rate than people who aren't. It's very interesting. I don't know why that's the case. Like, it just kind of seems weird, but like, I think once you kind of see the impact of what you're doing and how it's helping you, it's hard to shut your brain off. You start thinking like, how could I do this better? How could I do this more? How could I go harder? And then you start finding more income. So that's what Dave's talking about here. Like the motivation for success just starts shooting through the roof because now you're starting to see the light. You understand what's happening.
We are in sales now. We're out of the commission world. We're in like the salary and bonus because we're in management now. So it's salary and bonus. So going up helps a little bit, but not as much as it would if you were commissioned. You know what I'm saying?
Yeah. You could do a side hustle with sales training for non-competing companies. You'd make a whole lot more in DoorDash.
That's exactly
But just
right.
what do I know? But yeah. Anyway, you're doing great, man. I'm so proud of you. It's so cool. I appreciate you getting fired up on our stuff. And all it's going to do is just increase your peace level as those debts start dropping off. And even putting them in the crosshairs and knowing when they're going to drop off, the peace comes just from doing that. Even though you hadn't gotten there yet, just knowing you're going to be able to pull the trigger and knock them out. That's the thing. So, yeah, that's beautiful. Yeah. You'll probably end up doing the whole thing in about 6 years. That's going to be my prediction. And just this guy, his mind is already moving. So that's what, I mean, we see people do it all the time. Very seldom do you hit your goals on this stuff. You almost always hit them early.
That's right. Well, and when you're focused, right, whether it's losing weight or relationship growth, when you're focused towards a goal, then what happens is things begin to move in your favor that you didn't see. And we hear that all the time, and it's just a function of intentionality and hyper focus activity, and just things fall your way. And I actually would say, you know what, you're getting bonus probably on team performance. Instead of the DoorDash, I'd be working with these individual team members that you and your wife manage and lead. Help them grow, help them hit new goals. Boy, is that going to be fun, and probably going to fatten those bonuses, I would guess, if I was leading a sales team.
Yeah. Yeah, I think there's a lot of stuff you can do. It's fun. I mean, but your overall plan is not out of control, but keeping those debts forever would not be my recommendation. So let's just develop a plan for getting rid of them in some reasonable period of time. And or when you hit 59.5, cash out, because you're going to be sitting on in excess of $3 million, probably in excess of $4 million in those retirement accounts at that point, not counting your real estate. And the real estate will have continued to go up too. So you're going to retire at 65 with a $7 million net worth, give or take.
Wow,
that's a trek you're on. If you can, especially if you continue to make a freaking $400,000, that does help the equation a little bit. But up through some number of those years. So it's going to put you in a great, great place. Well, Dave, I can't be a baby steps millionaire. I don't make $400,000. 33% of the people that we found that became millionaires in North America, starting from nothing with no inheritance, did so with an income less than $100,000.
All right, so that's the end there. So I kind of like what he says at the end there, where recently someone had just posted on one of the things, I think it was one of the YouTube videos that I have, that said, all these rich people, they're all trust fund babies. Well, I'm not a trust fund baby. Statistically, most millionaires aren't trust fund babies. My partner's not a trust fund baby. I know several other people who aren't trust fund babies who are high wealth people. So, the data doesn't support that. And I think that you got to get that out of your head, realize, look, normal people can become wealthy. It's about this process of investing that will get you there. But I said that I would tell you what I think that Gary should do. And I have a plan for you, Gary, and it's low risk, but it's not about paying off the debt. So Gary got these houses like 5 years ago, he said. So his loans are probably amazing on these properties. They're probably like, 3%, 2.5%, 3.5% at most. Those are great numbers. And here's the deal. We're in a bear market right now. The entire market's on sale. Gary's net worth is probably even lower right now than it would be normally because of the fact that the market has been taking a hit. And that includes real estate. Real estate has been going down too, not tremendously, but it's been going down. He's still cash flow positive and he still has a net worth like this. So when you're looking at investing, we often consider what the average is over time. When you look at like the S&P 500, it has an average of about 10% gains per year. But what happens is there's some years where it goes down 5 to 10%, and there's some years where it goes up like 45%. So you don't want to be sitting right now in a bear market, and the opportunity right now to invest more money and not take advantage of that and then pay off the loans instead is a terrible idea. So here's my plan, Gary. This is what you got to do. Instead of paying off that debt, just let it ride. Just pay the minimum on those mortgages like you've been doing. Take the amount of money you would have used to pay the debt down and just start chucking it into index funds as hard as you can for the next 10 years. Then when you hit the end of that 10-year period, take all that money and go pay all the debt off. Like whatever it is that you have in those accounts, pay the debt off in one giant shot. That's what you do. Or you buy your house outright, whatever you want to do at that, from 10 years from now or 15 years from now, 65, whatever it is you plan on retiring, that's the plan that you're going to do. And the reason is, if we take a look at the Wealthy Idiot website at the compound interest calculator real quick, if he takes 1.5 million and he puts it into the S&P index funds at an average of 10% annual growth. And remember, it'll be higher because he's buying at the low time. So when it starts shooting up, it'll be above 10%. In 15 years, that money will be worth 6.2 million if he doesn't put any other money into index funds. And he said he has 1.8 in stuff that isn't real estate. So let the real estate stay there, let it appreciate, let it cash flow, buy as much as you can into index funds for the next 10 to 15 years, and then when you're ready to retire, go pay it all off and you'll be gravy for the rest of your life. So that's where I differ a little bit with Dave. I think that, paying off debt when you finally get to that retirement stage and being a little bit more secure is a good idea. It's something I plan on doing. But right now, while I'm building, trying to pay down debt when I'm cash flow positive on these properties, I have a great job that's making money and I can turn around and put all this money into index funds and build crazy amounts of wealth over the next, I'm not going to retire for another almost 30 years, right? I could work and get all that invested in that time. It's going to end up being huge. It's going to look way bigger than Gary's 6.2 number here. So, that's the route. Stay on the conservative side, but be smart. Do the numbers. Gary did the numbers. So appreciate it, Gary. Thanks for everyone for watching. I super appreciate it. Head to thewealthyidiots.com. You can check out our compound interest calculator, help you kind of guide your path through making sure that you're doing the right decisions here. I want to thank Dave Ramsey for letting me crap on him. I actually really like Dave Ramsey. And if you like this episode, give it a thumbs up. If you like Dave Ramsey, give it a thumbs up. Head over to his video, give it a thumbs up. Let's just be a little generous with all the love, and I'll see you guys next time.